We go. So today's webinar was planned in response to the dramatic collapse of Silicon Valley Bank earlier this month, and it replaced the previously scheduled webinar of Telling the Credit Union Story, which has been rescheduled for May. And later on in the webinar, I'm going to go over the schedule so that everyone is up to date on what we have in the coming months. So today's presentation is from MSIC President and CEO Mike Hanson, and it's about managing contagion and building consumer confidence, where he's going to discuss the impact of the Silicon Valley Bank failure and what that impact has on consumer confidence and trust, and then how we help to bolster and build trust with your members during these volatile times with the assurance of the stability of the MSIC Cooperative and MSIC's full deposit insurance. When Mike is done with his presentation, we want to invite you all to be part of an open discussion and a question and answer period, so everyone should feel free to participate. We do hope that you do jump in. This is a very timely topic. It's what we have been focused on over the past few weeks. So during that time, all participants, you're going to be able to unmute yourself. We ask you to jump in, introduce yourself, and share your thoughts or ask any questions that you have. And with that, I'm going to turn it over to Mike.
Thank you, Erica. Good morning, everyone. Thank you for joining us. I'd like to start by thanking the executive leadership of Silicon Valley Bank and those crackerjack examiners at the FDIC who have brought us all together today. Because as Erica said, when we were developing the long-term issues series of webinars for 2023, I had no idea that managing contagion would be one of the subject matters that we all have to deal with, but we do. So let's begin. This is part of that series, and Erica will give you the schedule. I hope you'll join us. All of these webinars are on our YouTube channel and are available for your use in the future, for your board, for the rest of your staff. I hope that you will use them. Today, we're going to talk about the banking crisis and the effects it's had on our credit unions, our cooperative, and most importantly, our consumer members. So start by recalling the condition of the MSIC Cooperative. Our assets are up significantly. Last year, they were up about 4.69%. Our capital of our cooperative is over 11%. Delinquencies are low. Our credit unions are, for the most part, well-run with experienced leadership, and all but 4 of them are well-capitalized under the NCUA's prompt corrective action regulations. This is important background information. So just a reminder, we're the first in the nation to provide deposit insurance to credit union members, and we are a true cooperative. We have 72 institutions. The cooperative has $32 billion in total assets. As I said, 11% capital, that's about $3.4 billion in capital. We insure over $2.5 billion in excess shares and deposits, and we all serve about 1.7 million consumers and organizational members. And we're the 4th largest credit union cooperative in the world. It's a true success story, and we just celebrated our 61st year. So when we think about handling threats to consumer confidence, we all have to start by understanding both the economic environment and the nature of any specific crisis. Here, I'm sure you're all aware of what's been going on in the economic environment. This is the 3rd major crisis we've had in the first 25 years of the new century. The volatility is significant. The pandemic caused us to put in the United States about $5 trillion into the economy in order to stabilize the effects of the pandemic. That is, of course, inflationary. We're dealing with inflation, and we're still dealing now with the after effects of the actions we took with respect to the COVID pandemic. The rapid rise in interest rates was not a surprise. We've been talking about it at MSIC for a while. We've been warning our member institutions that you have to be ready for a rapidly rising interest rate environment because we've been at generational lows for a very long time, and we've had a declining interest rate environment for over 20 years. An entire generation of banking and credit union leadership has never experienced a rising interest rate environment. And as we saw with Silicon Valley Bank, that can have disastrous consequences. Now, this background environment and the uncertainty and the anticipation of a recession is causing consumers to be on edge. And of course, it's not just consumers. That's what happened with Silicon Valley Bank. They had 90+% of their deposits were over the $250,000 limit. They were uninsured. Some of the most sophisticated business people and entrepreneurs in the country did substantial business with them. These high-tech startups would raise tens of millions or hundreds of millions of dollars in the IPO markets with their high-tech startups and put the money in Silicon Valley Bank, and only 250,000 of each of those deposits were insured. Then you had a situation in which the management did not anticipate or handle or know how to handle a rapidly rising interest rate environment. The directors and the executive offices started to sell some of their stock. The CEO sold, I think, 3 million or more of his own stock. The word got out. They were underwater in their investment portfolio. Their depositors got scared, and we had an old-fashioned bank run. They had to sell their investment portfolios at a loss, and in one day, they became insolvent. $42 billion of deposits flowed out in one day. So on a Wednesday, they were a well-capitalized, high-tech, high-rolling bank. On Friday, they were closed. That's the banking crisis. Now, a few others who had a similar footprint, if you will, in terms of their asset mix, that were in the crypto business, had a similar problem, and they collapsed as well. And then Credit Suisse collapsed, all from the same thing: a loss of confidence by their business, a loss of confidence by their consumers, and uninsured shares that flowed out. So over $1 trillion has flowed out of mid-sized banks. FDIC calls them mid-sized banks. We call them large banks. But over $1 trillion in the last year, half of that since Silicon Valley Bank. Last week, $100 billion in deposits moved out of these mid-sized banks and into the largest banks in America. Consumers are worried, they're concerned, and they want to protect their money. So you've got the recessionary background, the uncertainty flowing out of the pandemic, and now you've got a banking system that appears to be far more fragile than it really is, and consumers are moving their money. That's really the background, but it's a background of fear. The consumers are afraid and they're concerned, and that is a very dangerous mix in a potential recessionary environment. So the situation of the current banking crisis and the economic environment is very concerning to us, even though our members are really strong. We have 9% uninsured shares that are frankly insured in full by MSIC, and we don't have any of the asset characteristics or unrealized loss characteristics of some of these larger banks. But consumers, when they're afraid, don't tell the difference, don't know how to tell the difference, and they act based upon emotion. So why do we care about how the consumers are feeling? Our system is a fractional banking system, meaning that any institution has somewhere between 2 to 4% of their deposits in readily available cash. Runs exist because consumers are afraid, and depository institution failures, the actual cause of the failure is always caused by a liquidity crisis, and the liquidity crisis is caused by a failure of consumer and business confidence in the depository institution. Even a bank failure that's based on asset quality problems, at the end, if they don't get resolved before the end, the failure, the receivership will come when the depositors run. Many of us will remember Bank of New England. That's exactly what happened to Bank of New England back in the early stages of the New England banking crisis. They were in trouble. They had asset quality problems. There was bad press in Rhode Island as to what was going on down there. Consumers were denied access to their money in Rhode Island, and it was on the evening news. A bad news article came out about Bank of New England, and they lost $1 billion in 24 hours and had to be closed over the weekend. Back then, $1 billion was a lot of money, a big run, but it was the same dynamic as what happened to Silicon Valley Bank. And it didn't happen quite as quickly, but it happened very quickly at the end. So having our consumers confident is the name of the game right now. So you have to be ready to battle consumer fear before the fear starts. Once that fear takes hold, the battle is already lost. And so that's why we said to all of our members, prepare now and be ready. First, understand your consumers and your marketplace and have vehicles to communicate with your members. If you're not actively on social media, now's the time to get up to speed. If you don't have the right training for your frontline staff, now's the time to train them. Create the vehicles and understand who you're talking to. Each one of you in your institutions has a unique marketplace and a unique group of consumers that you serve. You need to attune all of your messages to that group. So start by trying to understand the unique characteristics of your membership base. 2, understand the crisis and how it will affect your membership. Here, we have some lucky characteristics. It's a bank, not a credit union. It is a long way away. It is not in our back door. The reasons for the problem were the mishandling of the asset liability asset base and the excessive amount of uninsured shares. None of our credit unions, none of us have that problem. Their business was totally different than ours. Those are really good elements to be able to say to your membership that it doesn't affect them. But you always have to be thinking how to distinguish your credit union from the institution directly involved in the crises. Do the necessary things to strengthen your credit union. Do it now and at the first sign of a potential consumer crisis. For this one, you need to build your liquidity. You need to add to your liquidity resources if you can. You need to train your frontline staff to be ready, and you need to develop your communication resources. Draft your notices if you think you're going to need it. I'm not saying to use them yet, but make sure they're ready to go. Order MSIC brochures now and annual reports. Make sure you have the resources ready if and when you need to communicate to your members. So you have that benefit of full deposit insurance. We're the only state in the nation, we're the only cooperative in the nation that can say that. So use it. Make sure you use this resource, because now's the time when your consumers will be really comforted by the fact that they're fully insured. Remember, we're not talking just about your members that have more than $250,000. We're talking about all of your members. Our research over the years has shown that every member, no matter how much or how little they have on deposit, is incredibly comforted, and it brings great stability when they learn that they are fully protected. Many of the calls we get at MSIC, and we've gotten about 60 since Silicon Valley Bank, many of them don't have 250,000 in the bank, but they want to know about their protection. They want to know about their credit union, and they're very relieved when they learn that you're a member of the cooperative. Now, there's some things you can say, and you should train your staff to be able to say. And I've listed some quotes here. The NCUA and MSIC together provide full deposit insurance at no cost to you. This is a benefit you receive by being a member of our credit union. You can see the themes I'm trying to hit. The NCUA is the credit union equivalent of the FDIC. It provides the same level of federal protection, generally $250,000 per insured depositor. In this case, you can say the current crisis is a banking crisis. The FDIC has to cover that. The NCUA does not have such a problem, and it remains very strong. Another one is credit unions are in very good shape because they primarily provide consumer and small business services. And if it's true, you can say our credit union has significant capital, plenty of liquidity, and no problems. We are not like fill in the blank, Silicon Valley Bank, or any of the others that are affected by the current crisis. Now, MSIC was the first credit union deposit insurer in the nation. It's part of a credit union cooperative of 72 institutions with total capital of over 11% and total assets over $32 billion. In its 61-year history, no consumer has lost a penny of their savings or been denied access to their funds in any MSIC-insured credit union. And we provide you the highest level of deposit insurance in the nation at no cost to you. You can see what we're trying to do here. Now, once you think through which messages work best for you, you have to deliver the message. And this, my friends, is an art and not a science. And it depends a lot on your unique circumstances. But we're going to cover some basic topics here today. Your first line of defense is always your frontline staff. You need to train them now. Anyone who interfaces with your members, whether it's a customer service rep, a teller, or someone in your call center, they should be trained now as to how to handle a consumer that is scared enough to ask about the safety of their money. And when you train them, you have to train them to deliver a consistent message, not verbatim. You don't want everyone to read from a script. You want them to be able to speak at the consumer's level in a way that is personable and that builds trust and security and belief without misleading the customer at all. That's hard to do, and it requires advanced planning. So with your frontline staff, make sure they understand your credit union's strengths. Not too much technical or financial details. You need them to communicate at the consumer's level. It doesn't do any good to train your staff to talk about the finer points of your unrealized loss exposure on your investment portfolio. But it does a lot of good to let them know that the institution is sound and has a solid investment portfolio to back its business activities. Again, you want to be thinking like the consumer. If it's true, you want to emphasize you're well capitalized, you have excellent liquidity, you have a loyal membership base, you've been successfully in business for 80 years, 100 years, and you're well regarded in the community. These are all things that a consumer want to know. Make sure your staff understand the particulars of this crisis and how you differ from that crisis. Make sure that you have not, if it's true, make sure that they know you've not experienced any deposit disruptions. If you have experienced deposit inflows, let your staff know that and let them tell that to consumers. So far in this crisis, the MSIC Cooperative, and I've been in touch with many of the CEOs, we have not had any deposit disruptions. We've had a few calls at each institution. They've been able to handle it successfully. And in fact, a number of our CEOs have reported to me that they're receiving deposit inflows from savings banks that used to be insured by the DIF and aren't anymore. And so those factors that you're showing security and stability in this market are things that your frontline staff should know in general terms and be able to communicate them to the consumers. And they need to know how to distinguish your credit union from the institutions involved in the crisis in consumer-friendly terms. Now, it goes without saying that they must always be truthful with the consumer. They have to avoid BS. Consumers who are already scared enough to ask about a crisis are looking for it, are sensitive to it, and will detect it every time. So you have to engender an ability in your staff to be knowledgeable about the crisis, knowledgeable about the strengths of your institution. They have to exude confidence, and the best way to do that is to conduct business as usual. Generally, it's a good idea not to bring up the crisis. If somebody doesn't ask, you shouldn't bring it up as a rule of thumb. But they need to be ready to respond to questions right away when asked by the consumer, and they need to do it in a way that shows confidence and you're operating in the normal course. So they should always remind the consumer that their money is safe. They should talk about your track record and your history, and the credit union is healthy and strong, if it's true, and committed to their success. Those concepts are there. Now, some of this will seem obvious to those of us who've been at this a long time, but it's always in the execution, not in the strategy. The trick is to train your staff now to do this successfully and consistently if necessary. So after your frontline staff have answered consumer questions calmly and truthfully, offer for the consumer to have an opportunity to speak with a supervisor. Having such an opportunity will assure the consumer that they were getting the truth from the frontline staff. Well over 50% of the time, the consumers will say, no, it's not necessary, and they'll be satisfied. But an appeal process shows truthfulness, and it shows that your frontline staff doesn't have anything to hide, and that the consumer has an opportunity to validate the information they got. It's a good process to have. Now, it should be able to go right to the president if necessary, but I would not make that the first step in the appeal if you have that option. But the president should always be available to the consumer if they want to go up the chain all that way. And as I said many times, just the offer of speaking to someone higher up in the organization will calm the consumer, and they'll be satisfied in the responses that they're getting. Again, business as usual is the best defense, and actions are actually more important than words, but they both matter. And the consumer will be watching what you're doing and how you're doing it. Now, remember, once again, all consumer members can cause fear. It does not matter how much they have on deposit. Treat all of them with the significance that they deserve. If you want to see what a bank run looks like, hopefully you've never experienced one in reality. I have. But if you want to, there's two good examples. One is the famous movie that showed it, It's a Wonderful Life. It showed a bank run. But the one that I think is the best one is the old Mary Poppins movie. If you remember, Michael, the little boy, screams in the lobby of an old bank, "I want my tuppence." And the next thing you see is consumers fearing that there's something wrong with the bank, and they show a very comedic run. However, that's what they really look like. Fear takes over, and there's no talking to a consumer who thinks their money is at risk. Happened to Silicon Valley Bank, just like that. So remember, every consumer can have fear and can cause you a great deal of disruption. So they all need to be addressed in your efforts and in your planning. So the role of the president: answer your phone. So many of us have phone systems that are really not consumer friendly. Take calls directly. Be available and responsive. There's no time for an imperial presidency. You need to relate to your member, you need to relate to the consumer, and you need to be available to exude that confidence that is necessary right now. Business as usual is the best defense. Actions and words matter. Don't seek out the media, but never avoid it. Always be available to speak to the media if they have concerns. If you look like you're hiding, you're going to have bigger problem than you would expect. Make sure you're monitoring social media. Your organization needs to be monitoring it. If you're actively doing that, great. If you're not, you need to start the process, and you need to respond quickly to any adverse commentary about your institution on social media. Have responses ready to use by the president, and senior officers should be the one to respond. Social media is not our friend because it has no basis of truthfulness. There is no vetting, not like the media where they're trying to find out the truthfulness of what they're reporting. On social media, people can say whatever they want to say. Most of it is very uninformed. That's why you need to be monitoring it, and you need to respond quickly if something is adverse and untrue about your institution. For everyone in your organization, you need to communicate calmly and clearly, be truthful, and build trust. Now, hopefully, that process started long before this or any other crisis. Remember that these consumers, your members, already chose your institution for their financial needs. You have a real advantage in the trust business because that's the name of our game, and we've been doing it for a very long time. Use that trust well in this situation and never violate it. Never mislead your consumers. Help them achieve their success. Help them achieve their security. If a consumer is concerned after they talk to the president and they go through it, work with them to maximize their NCUA insurance. If they have everything in a single account, but they can break it up into $250,000 pieces, make sure you do that. Help that. That action of helping them to maximize their insurance will help build that trust and show the consumer that you really are concerned. And make sure you stay in touch with your membership and your market area. This is not a time to be missing in action. You need to be really monitoring the level of fear within your communities that you serve. So here's a question that comes up all the time. Should you send a notice to your entire membership? Don't do just the excess deposit holders, because you don't want to treat one group of members different than the other. And that fact of sending out a notice to some but not others will create uncertainty and fear. So if you're going to do it, you need to send it to all of your members. And you have to be thinking about your unique circumstances, because here, you don't want to raise a concern when none might exist. You're reminding people that they are fully insured and you have nothing to worry about your money will raise in a number of them the concern, what's going on that they have to do that? So you want to think about it carefully as to whether it serves your objective to do that. And your communications can cause the problem you're trying to fight against. So it's a judgment call based on your membership base, your community, and what's going on with your business. But prepare one now. So is a dilemma of the bank commissioner and the governor in any situation like this, going back to my service as commissioner during the New England banking crisis, we learned the hard way that a bank commissioner or a governor coming out and telling people you have nothing to worry about, your money is safe, causes them to then go take their money out, because otherwise we wouldn't be saying that if there wasn't a problem. And secondly, they don't trust government anyway, so it's not going to do any good. So it's a real problem in avoiding circumstances where you are creating the very problem you're trying to avoid. So you have to be careful on this one. It's a tough business call. It's a judgment call as to whether you send something to your entire membership. A lot of it depends on the unique circumstances and what's going on in the media at that time. Now, you should prepare one. You should have one ready. And here are some really good samples that I'm going to show you. First one is from Webster First. Mike Lucier signed it himself. And it says, your deposits are fully insured at Webster First Federal Credit Union. and I'm going to read it to you. And these are available. We'll be sending them out to all of our members in the next day or two. It says, in light of recent news, I'd like to take a moment to reassure all our members at Webster First Federal Credit Union that your deposits are 100% insured. Webster First deposits are federally insured by NCUA up to $250,000. In addition to this insurance, all deposits in excess of the $250,000 NCUA limits are fully insured by MSIC. For over 90 years, Webster First has committed to making sound, responsible financial decisions, resulting in us being one of the strongest, most fiscally secure credit unions in Massachusetts. Fully insuring all deposits through a combination of NCUA and MSIC is part of our fiscal responsibility commitment to our members. You can rest assured your money is safe at Webster First Federal Credit Union, and signed by Mike. Now, you can see from hearing that, he's hitting all the big topics: calm, secure, fully insured, 90 years, commitment to members. It's a good example to use. It's also short, it's sweet, and it's readily understandable by the consumer. So it's a good one to follow. Here's one from SCU Credit Union. And you know, the woman with the blanket and the cup of tea or coffee couldn't be better. You're secure at SCU. SCU Credit Union has been serving the communities of Southeastern Mass for over 65 years. We are a strong, well-capitalized financial institution that takes pride in providing our members with the financial services they need to succeed and grow. In today's ever-changing financial landscape, we want to remind members that they can feel at ease knowing their deposits are 100% secure. SCU member deposits are federally insured up to $250,000 by the NCUA, an agency of the U.S. federal government. Member shares and deposits in excess of NCUA limits are fully insured by MSIC. We are here to answer any questions that you may have about your deposits and other services with us. Please don't hesitate to visit one of our branch locations or call us at the number. We thank you for being a member of SCU Credit Union. Again, an excellent example for you to follow if you're preparing a draft for your members. And once again, do it now. Have it ready to go, and let's hope you never need to use it. So I want to thank Mike Lucier and Glenn Parsons, the CEOs of Webster First and SCU. They're both long-term friends of MSIC, and they authorized me to use this, and I'm sure they will be flattered if you copy some of their ideas in preparing your own. So before we open the discussion, I do want to give you a little bit of our confidential analysis. We, of course, have an active monitoring program. Early risk management is how we help our member credit unions thrive, and where we are as a cooperative today as a result of those actions and this analysis. But there is a next potential wave of this crisis. We are not by any means through it as far as we're concerned. We're lucky in that Silicon Valley Bank and Credit Suisse are a long way away, as are the other banks in the minds of the consumer. And we look nothing like those institutions, and our credit unions have a totally different business model. And it's really easy for us to distinguish ourselves in the minds of your consumers. But our local concern is that a bank gets into trouble here in New England. There were 3 Massachusetts banks, both savings banks, that no longer have full deposit insurance because the Division of Banks required that they exit the DIF because they became too large. They signed that national petition asking the FDIC to fully insure deposits for the next 2 years because they're having a significant liquidity outflow. Hopefully there'll be no problems, but we should be ready now in case a New England-based bank gets into serious trouble, because then the problem is a local problem, and you'll have to revisit the concerns of your consumers once again. A local problem will cause a great deal of consumer anxiety, and we should be ready for that and be looking for that in the weeks and months ahead. In addition, we have to remember that coming out of the pandemic, not only do we have the rising interest rate environment, we have a complete restructuring of the commercial real estate marketplace. There's a lot of buildings out there as companies have downsized that they're still in hybrid format. They're not renewing leases at the same size or the same rates. Values are down. And I think we have to be concerned about a commercial real estate problem where there become loan delinquency problems that further destabilize some of these larger banks. Now, I don't know that that's going to happen. I'm hopeful it doesn't, but it certainly is on the horizon, and it certainly is a looming problem in a rising interest rate environment, which we're still in. So I think we have to be watching our delinquencies, continuing to build our liquidity, and being ready for other parts of this crisis to hit us on our doorstep. So vigilance is key. Prepare now and make sure that you're delivering a consistent message. You know, I always say when I give a talk like this that people rarely invite me back because the message is so negative. But the truth of the matter is our credit unions, all of you have done a whale of a job. You've done a great job. Your consumers are satisfied, they're secure, they know their money is safe, but we need to keep it up. We need to be ready in case this comes back again. So I welcome your questions and your comments and discussion. And if any of you disagree with some of the things I've said, please speak up so we can have a discussion.
Thanks, Mike. So there's a couple of ways to participate. If you want to type your question in, you're welcome to do that. You can do that in the chat or the Q&A box that's found at the bottom of your screen. The other way you can participate is there's a little raised hand sign. It looks like this. If you raise your hand, I can unmute you, and then you can ask your question. So there's a few ways to participate, and we hope that you do. We did have a question come in while you were speaking, Mike. So I'll jump on that one as we wait for people. How do we respond to a customer who is thinking of joining our credit union, but says it sounds like a good deal, but the government will bail us out in a time of trouble?
Well, so you respond to that the same way you do what you do with a consumer that's concerned. You hit the highlights of your organization. Why is it good for them to be a member of your credit union? And that's always the case. You do that in your regular business activities. There's a good reason for consumers to join their local credit union, and you should portray that. In terms of concerns about the crisis, you use the same methods we just talked about here today. However, we do face a battle with the larger institutions in which it is clear that the federal government will bail out a large institution because they will create a systemic risk and take down the economy. But that's not guaranteed. And that's an important thing. You and I know that they will do it, and they will have to do it. If Bank of America, Citibank, JP Morgan, Chase, they get into trouble, there's no way that the federal government can allow them to collapse and have uninsured deposits. But it's not a guarantee. The insurance you deliver, the 100% insurance you deliver, is guaranteed on day one. And I would use that factor in your presentation of the benefits for a consumer to join your institution. And then all the other ones, local control, they can reach their lender. You deliver better rates, and they own part of their financial services provider as a depositor, as a member. They're an owner, and all of those things that make the credit union movement beneficial, and why we're growing, at such a huge rate nationwide. All of those things still come into play, and even more so with your 100% deposit insurance. But it is a competitive environment out there, and you're going to have to go get those new consumers.
Mike, another question that came in: will MSIC membership add new credit unions? Is there increased interest?
What was the last part of that, Erica? I couldn't hear
Is,
that.
is there increased interest? Sorry.
Yes. I can't disclose any more than that, but yes, about every decade we get something like this and people remember why they're a member of the MSIC Cooperative. And yes, we've had expressions of interest. As some of you know, we've been trying to expand throughout the New England states and New York for 20 years with the commissioner, because that's our best way of handling future concentration risk. And we've been unsuccessful in convincing the commissioner. I've had 6 calls from institutions outside of Massachusetts wanting to join. And I've had interesting conversations with them, about our future prospects. And we've had some calls from within Massachusetts. And the MSIC board will be considering, this at their next meeting. So if you know of other right now, state chartered credit unions who accept deposits over 250,000 must, under the credit union law, be a member of MSIC. There are a few credit unions, small state chartered, that are not members. We encourage them to join. It will cost them nothing, and they can be part of the community. And they don't offer excess deposits, but they should be part of the community so that they can get all of the benefits that we provide in addition to excess insurance, and it's free as long as they qualify and are healthy. For federally chartered credit unions, we have quite a few that have chosen to be members of MSIC, and there are a few others that are moving along that path. So I do expect we will have more membership in the next year or so.
Mike, there was a comment. Do you want to mention what happened in Rhode Island a few years ago when some shares were frozen?
Yes, that was the New England banking crisis. It happened just before I became a bank commissioner in April of 1991. Yes, I am that old. Uh, so what happened in Rhode Island is their insurance system collapsed as a result of massive fraud. It was an insurance system that handled both banks and credit unions. And Governor Sondland at the time handled it exactly the wrong way. And this was a state system, so there was no NCUA involvement, no FDIC involvement, which of course was idiotic to begin with. And Governor Sondland froze all the assets of all of those Rhode Island banks and credit unions. And for a year, consumers were unable, all their checks in process bounced, and consumers were unable to access their money. It took a year for them to figure out what to do. Now, if you want to read a textbook of how not to handle a crisis, I give you the Rhode Island example. They did virtually everything wrong, and it caused enormous disruption because consumers couldn't get their money. And there was night after night of television news reports of consumers going to the State House in Rhode Island and banging on the governor's door screaming, "We want our money." Well, the media market is a Boston media market, even for Rhode Island. And so all of Massachusetts was seeing this every night. And for about 6 months to almost a year, the Fed was sending me liquidity reports, and Massachusetts institutions, credit unions and banks, had a massive outflow of liquidity from consumers getting scared by watching the Rhode Island disaster. And we communicated, we had CEOs communicate that Rhode Island is not Massachusetts, and we were battling this concept, but consumers aren't really listening to anyone when they're afraid. The end result, which is very interesting and unfortunate, is we had a tremendous number of consumers, including many older people, who literally took their money out and put it under their mattress. This is Depression era stuff. We had a lot of that. And what did follow? Massachusetts had a big uptick in burglaries. So it was a disaster. Very few people remember how close, and then of course Bank of New England failed, a nice local Boston bank, and then all the savings banks that had gotten over leveraged in the commercial and condo real estate boom of the mid to late 80s. They were failing. I closed 47 institutions in my year and a half as bank commissioner. I've set the record. So we were very close to a meltdown, and and very few people know that. We kept it quiet. The Fed was excellent. The FDIC was horrible. And we were very close to ending up like Dallas, where every major bank in Boston was going to fail. And through a combination of a lot of hard work and a lot of Maylocks, Governor Weld and Lieutenant Governor Salucci and I, and working with our congressional delegation, we were able to get New England through a very difficult time. But it started with a foolish error by the Rhode Island governor. So that's a thumbnail sketch of a very long-winded answer.
And one more, Mike. Why aren't some credit union members of MSIC?
Why are they or aren't they?
Aren't. Why aren't?
Well, that's an excellent question. And I would ask the same question. Some of them we won't take. DCU, for example, we would never take them. They are so much larger than everybody else. They're a fine credit union. They do great work. Their growth over the decades has been phenomenal, but they're too large and they would be too destabilizing to our insurance fund. So they're out of luck. Most other credit unions we would consider. Of course, we are concerned about dilution to our fund, so that's a big issue. But a few credit unions believed they didn't need it, and I think that they were wrong. And every once in a while, these crises come along and remind us of why we're doing this for consumers. It is a tremendous benefit to your members and is a tremendous tool in growing your franchise. So, but a few have made that decision that they didn't feel that they needed it, and we're out there. But when you look at all of Massachusetts, now let's take DCU out of it because they're so much bigger. They skew all the numbers in the analysis. So if you don't include DCU, 76% of the credit unions in Massachusetts are members of MSIC. And most importantly, like 78% of the consumers that do business with credit unions are insured by MSIC. So it's a very dominant position within the Commonwealth that we've been able to do as a group, over the last 61 years. We encourage people to provide this. It's the only state in the nation that has this public policy of full insurance for consumers. It brings great stability to the entire Commonwealth. Some of these non-members benefit from that stability, but that's okay. But we do encourage them to think about it before the next crisis hits.
All right. Are there any other questions? This would be your opportunity.
Thank you all for attending.
Hang on a second, Mike. All right. I'm going to read to you what was written. Mike, as consumers have concerns regarding their deposits, any thoughts on the current and future use of corporate credit unions by credit unions? Many small to medium credit unions rely on corporate for the majority of their liquid assets, as do we. I know there has been many changes for the good of regulatory oversight of corporates. I'm not aware of any NCUA concerns from a concentration perspective. It would be extremely difficult for a credit union for a credit union to spread their deposit, but over multiple deposit options.
So there's several elements of that question right there. I am not aware of any current problems with the corporate system. If you remember, the last time we had a major crisis, I guess it wasn't the last time, but the 07-08 crisis, the corporate structure was a pyramid. It was terribly designed, totally wrong. and it concentrated risk. It did not diversify risk, and we all paid the price for that for a very long time. I don't see that now. I do say that it is a good idea, without commenting on the corporates, of which I'm not aware of any problems. It is a good idea to take a hard look at your cash positions that are uninsured. It's probably a good time to try and insure as much of those as you can with either FDIC insurance or NCUSIF insurance. It's probably a good idea to keep an eye on that. It's a good idea to try to keep your investment portfolio short, that you manage your unrealized loss exposure to the best that you can. It's a little late for that, but it's a good idea to do that. In terms of your liquidity sources, you should use the corporates, but you should also look for backup liquidity sources. If you qualify as a member of the Federal Home Loan Bank, I encourage you to look into that. If you qualify for the Fed discount window, I encourage you to look at that. And also some banks and other lenders might be able to provide you some short-term liquidity. MSIC itself can do that for smaller institutions, but for any institution that is of any size, you should be making sure that you have multiple liquidity sources and that you are spreading your cash positions in ways that minimize your risk of loss for uninsured deposits. That's hard to do. It requires a lot of legwork, but it's probably a good idea to make sure you're not in a vulnerable position. And if you have specific concerns that MSIC can help you with, feel free to give me a call and I can walk you through some ideas in your particular circumstances. But right now we need to be careful. I don't know where this is going to go. I hope that the crisis goes away and that the stock market continues along its merry way and that we avoid a recession that's at least too deep. But I'm not betting on that. I think we are going to head into a recession. I think there will be some other problems, and I think we have to be aware of consumer problems. So for your own institution, take a hard look at where your concentration risks are and try to minimize them if you can. Good question.
All right, Mike. Well, aside from many thanks from different attendees and saying that this was an excellent webinar, it does look like that is it for questions and comments.
I would say, Erica, if
Yeah.
anybody has any questions or comments, call us at MSIC.
Absolutely.
Email us, email anyone on the team, myself. My email is mhanson@msic.org. Feel free to reach out. We're here to help you. And we're here to help your consumers. We've had as I mentioned, about 60 calls, and we're here to guide them through the facts so that they can rest assured that your institution is safe and sound.
So that concludes today's presentation. I know a few of you asked. The recording of today's webinar will be available on our website and our YouTube channel. That'll be early next week. Will be available, and the PowerPoint slide will also be available. You can email me to request that, no problem, or I can distribute that to all of the attendees. Yesterday, you should have received an email from me with an update of all of our upcoming webinars through the end of June. So just to quickly go over them, we're going to continue the series regarding long-term issues for credit unions with Mike. The next one will be on Tuesday, April 11th at 11 a.m. It's the merger fallacy. And then we'll be doing the telling the credit union story, which was what was replaced with today's webinar. That's going to be on Wednesday, May 3rd at 11 a.m. And then at the end of June, Thursday, June 22nd, we're going to broadcast the keynote speaker at our 61st annual meeting. That was Tim Barrett. He's the president and CEO of the Federal Home Loan Bank of Boston. Please share this with your management and your executive staff. Register, sign up, participate. We're always glad to see you here. And that's it. Thanks again for joining us. Have a great day. And again, reach out if you have any questions. Thanks, Mike.